human psychology is completely incompatible with investment principles. Investing is pretty easy on balance. You just have to buy when things are low and sell when things are high. There's no questions to be asked about that, but it's really difficult to do because you have to buy when you're uncomfortable and sell when you're comfortable with the investment.
I'm really looking forward to getting your thoughts today because it feels like every time we turn on the news or we open up our phones, we're hearing those buzzwords. We're hearing volatility, we're hearing instability, uncertainty. And for somebody nearing retirement, that can be very unsettling to hear. So let's start big picture. What actually makes the first 12 months of retirement so different from maybe, those last few years leading up to it?
Yeah. So it's a great question. And for years and years, while people save for retirement, investors, rightfully so, they're focused on magnitude of returns, right? How they're asking themselves, how can I configure my portfolio so that I can get, that extra 0.5% on average and compound those earnings as much as I can? You just want to pile up as much money as you can as you approach retirement. But the difference between all those years when you're accumulating assets and the first 12 months of retirement is seemingly obvious, right? It's the paycheck that you were leaning on to do all that saving. But when you flip that switch and you start leaning on your nest egg for supplemental income, or even if you don't need the supplemental income, we see that a lot. People just need it for one-off expenses, for vacations, whatever it is that they want to use it for. A distinct shift in strategy should happen because while magnitude of returns remains important in retirement, what becomes even more important in those first 12 months especially is reliability and consistency of those returns. So what makes it different really is the strategy and thought process around the money.
Yeah, I think that's an important distinction because for most people before retirement, it's all about that accumulation. Like you said, you're adding money, you've got time on your side. In a market drop, it might feel uncomfortable, but it doesn't feel fatal. But once you flip that switch into retirement, the rules really do change. And that kind of leads us to a risk that a lot of people don't hear about until it is already impacting them. So let's define that big hidden threat, Ryan. Talk to us about what sequence of returns risk is and why does it become more dangerous once those withdrawals begin?
Yeah. So sequence of return risk is just the finance world's way of saying, it's a fancy way of saying what kind of market environment exists in those first 3 to 5 years when you flip that switch and go into retirement. In other words, if you were to retire today, what are the returns in 2026, 27, and 28? Because mathematically, those first few years of returns have a huge impact on the long-term trajectory of your retirement plan. And because during the accumulation stage we talked about, while you're still working, you could look at that negative, market environment, if it was negative, as a buying opportunity, like you were saying. But because you have time on your side, you're making those recurring contributions. But once you've retired, you're at best a holder, right? If you don't need your money in order to live the way you want to live. And at worst, or very worst, a seller and into a down market, right? Because if you have a negative market environment in those first few years, a negative sequence, then you might find yourself needing to take supplemental distributions to cover the bills. And, that's what makes it so dangerous is that can compound an issue if you have a negative market environment, which is really hard, if not impossible to predict. And it can make it more difficult for the portfolio to recover, even if your longer term returns are pretty attractive.
Yeah, I mean, the timing of those returns can really change everything for someone. So it's hard to visualize until I think maybe you see it play out. So I'm wondering if you could walk us through a simple example where two retirees, they earn the same average return, but one runs into trouble because the losses happened early in retirement for them.
First, what I'll say is it's a great question because one of the primary issues in our industry is all the time, when someone comes in and wants to evaluate an investment for their portfolio, one of the first questions that I get, or one of the first pieces of information that's requested for me and is requested from a lot of advisors is, well, what's the track record of the investment? What is the long-term average return? Like what kind of returns did they get over the last 15 years? And the problem with that question is how do we really know the risk of that investment unless we know how much the portfolio fluctuates in value? For example, if I said, hey, the long-term return of this investment is 5%, right? What does that really tell you? Does that mean it's up 5% the last 3 years in a row? Does that mean it's been up 30, down 20, up whatever averages out to 5? Without knowing the volatility, how do we really know the risk profile of that investment? And you can see that most commonly played out with the S&P 500. So the S&P 500, people look at it and they say, well, the long-term average return is a little over 10% per year. But the S&P 500 also has periods where it fluctuates in value a lot, right? So let's just, to get to your example, let's say we have a retiree that's considering, pulling the plug and starting to live off of that nest egg, and not necessarily living off of the wages anymore. And they want to start living it up and doing the things they want to do. Well, let's also say it's December of 1999, and that's normally, right, the where people say, "Stop, Ryan. I know you're cherry picking those numbers, but that's another problem with investing, right?"
Mhm.
Nobody was saying in December of 1999, "Hey, I've saved up all this money. I'd really like to retire, but maybe I should wait a few years because my base case is that we're going to have a tech bubble bust and then a few years of global conflict that's going to cause down years of down 10, down 13, and down 23, which was what actually played out in 2000, 2001, and 2002. Well, if you have that retiree that maybe saved up $1 million and they need $40,000 out of that portfolio every single year, which is a 4% withdrawal, after those first 3 years of their retirement, 2000, 2001, and 2002, now their 4% withdrawal rate, that same $40,000, represents almost 8% of the portfolio value because they had a negative sequence of returns. But if you had this investor, that same investor that chose just a slightly different timing, slightly different sequence, and they retired in 2003, their first few years were 26%, up 9%, and up 4%. That's a huge difference because those first few years better prepares them and they're going to see net growth of their portfolio value, net of a 4% withdrawal. And then when it comes down to it, and when 2008 happens, which is a few years later, they're in a much better position to handle that market decline. So neither of those scenarios are something that's completely predictable, but it's just an example of how dangerous sequence can be. And the S&P 500 has been the best place to have your money invested for the last century. So it wasn't necessarily a poor investment, Joyce, just poor timing.
Yeah, great example, Rhyme. Same average return, totally different outcome for those two people. And
Yeah,
that is scary for retirees because they cannot control markets. But what you can control is how your income plan responds to markets,
right.
which kind of brings us to something that you talk about a lot when it comes to that first year of retirement, protecting yourself. So, protecting yourself during that first year. So, talk to us a little bit about some of the best shock absorbers for retirees. What do you prioritize during this time on that front and why?
Yeah, so there's different ways to go about this, and it looks a little bit different for every single person that comes in, depending on your tolerance for risk, depending on how much money you need from your portfolio. But for everyone, the most important thing to do, and what just generally as a rule of thumb makes a lot of sense, is that everybody, no matter where you are in that retirement journey, you probably have a need for some dollars that are allocated to safety in the portfolio, some dollars that are allocated to growth, and maybe some opportunistic funds that are given the name aggressive growth. The amount that goes into each category, like I said, is completely personal, and what makes up those categories is also personal, but it depends, again, on how much you need from that portfolio and what timing you need it in. And then ultimately, we have to come to terms with the fact, like you said, that nobody's going to be able to predict the onset or magnitude of these market declines. So, what becomes really important is that you have a plan in place for where your dollars come from, where that retirement paycheck comes from in different market environments. If you retire into a time period where the market cooperates, well, then that's when the money should come from those winnings. If you retire into a time period where the market, you just have a negative sequence, something you can't control because it was unpredictable, well, that's why you have safety in the plan so that you don't have to sell stocks when they're down.
I like using that phrase shock absorbers because I feel like it takes the pressure off your plan having to be perfect. It's about building a plan that can bend a little bit without completely breaking. And, part of that flexibility shows up in how retirees actually spend money when markets are down. So, can you explain to us if markets are down early in retirement, what should retirees adjust first? And then just as important, what should they avoid doing altogether out of fear?
Yeah, yeah. So if you take a proactive approach, and this is optimistic on my half, but I think if you take a proactive approach and you make sure that the portfolio is allocated appropriately ahead of time in retirement, you may not need to make drastic adjustments in your spending depending on what the market does. That's the whole purpose of building out a retirement plan, right? You would just need the adjustment would need to be where the funds are coming from. So I just gave that example. In a negative market environment, you want to be living off of your safe money so that your growth-oriented investments can recover. And in a good market environment, you want to continue to trim from those winnings. Nobody likes to take a call from their advisor where the advisor says, "Hey, I know you want to take that hard-earned vacation that you worked hard to, save up money for, and you just retired and we're early in retirement. but XYZ thing, crisis du jour, just happened in the market. And so maybe you need to wait a year or, a few months in order to do that.
Mm.
Although if you're willing to make those course corrections, obviously the probability of your plan just skyrockets.
Mhm.
But to the extent that we can, we want to insulate ourselves from having to live on that market schedule. And if we have a disciplined, balanced approach going into retirement, instead of just giving every single dollar that we have the name maximum growth, the likelihood is that you can put yourself in a position where you don't have to make those dramatic adjustments. And when you do, they can be a lot more minor than adjusting, travel or large purchases, vacation plans, that kind of stuff.
Do you feel like those fear-driven decisions usually turn out to be the most expensive ones?
Absolutely. Yeah. Yeah. That's the biggest thing, and whenever people come in and there's fear that's driving decisions, more money is lost when you react to those things than is lost in any kind of downturn. Human psychology is completely incompatible with investment principles, right? Investing is pretty easy on balance. You just have to buy when things are low and sell when things are high. There's no questions to be asked about that, but it's really difficult to do because you have to buy when you're uncomfortable and sell when you're comfortable with the investment, right? So
Yeah.
when people come in and they're nervous, what we have to do is we have to remind them of the plan we have in place and why we do what we do. Diversification could be an overused term in our industry. Part of what that means is that every time I sit down with someone and I look at a portfolio and someone who's retired or approaching retirement, there's a good likelihood that a piece of their portfolio is not performing as well as another piece, right? They have something they're disappointed in. And I always joke, I say, look, if everything was headed in the same direction and you were completely satisfied with every strategy we were implementing, then I'm probably not doing my job because you're probably exposed to some kind of risk, right, that we're not seeing. And the best objective for a retiree, if you're looking to invest in and throughout retirement, is you have a variety of strategies at play, right? We talked about safe money, we talked about aggressive money, and then you turn to the one that's best working in each market environment. And hopefully, if you have enough diversification at play, you always have something that's working, right? It's not going to happen 100% of the time. Nothing's guaranteed, but that's the idea. And you're so right about the emotional mistakes with money. It's just about having a plan so that you can revert back to that plan when those uncomfortable times happen.
Yeah. I mean, not every downturn has to be a disaster, but reacting the wrong way at the wrong time actually can turn into a disaster.
Yeah.
Too. So if somebody is planning to retire this year or they just did, what are the top three, would you say, first year moves that you'd want them to review immediately?
Yeah. Okay. Number one is, to the extent possible, consolidate your investment accounts into as few institutions as possible as you approach that retirement age. It's really, really difficult to track your overall allocation, performance, and some of the things we're talking about and shifting to the strategies that are best working when your dollars are spread out on several different platforms. And it's extremely important to have a good handle on this, when you're moving into the distribution phase of retirement. Number two would be to remember that your time horizon isn't as short as maybe it's perceived to be, right? All the time I hear, hey, I don't have time to participate in this recovery, but it kind of helps avoid taking, it helps you avoid taking, emotion into the equation when you think practically about this, because people save incrementally for decades as they approach retirement, and then they retire. And most people take distributions incrementally for decades, right? Most people don't make the call and say, hey, I need all my money at one time.
Mhm.
Most people are taking that money out incrementally. So that extends their time horizon and means that you can follow an approach that still has some growth in it. You just need to have a plan in place. And to that would be my third thing, is just understand the risk profile and the risk that you're taking on in your portfolio. No one should follow, dangerous rules of thumb, like take your age, subtract it from 100, and that's how much you should have in stocks. You just like you wouldn't go to the doctor and say, hey, an apple a day keeps the doctor away, so I'm not going to schedule my next appointment, right? You wouldn't do that. So in the same way, you wouldn't follow those rules of thumb. It's different for everyone. But even if you plan to self-manage going into retirement or going into those first 12 months, I'd recommend getting a second opinion of what you're doing just to make sure you're covering all your bases. I mean, worst thing that could happen out of that is you go to a fiduciary advisor and you ask them, hey, what would you do differently? And they say absolutely nothing. Or maybe they give you some feedback that would be helpful for you. Just, it's best to go in as educated as you can to avoid emotional mistakes and be best prepared.
Yeah, I think the takeaway I'm hearing from our entire conversation today is that volatility does not have to derail your retirement, but that first year really deserve some extra attention and intentional planning, really.
Yeah.
Yeah, well, if that's something that you're looking for, I just want to remind you that you can get connected with Ryan and the entire Abich financial team. All you've got to do is visit theretirementkey.com. All the links can be found in our show notes today for you. And as always, we appreciate you spending some time with us, and we will see you right back here next time on The Retirement Key. Thanks so much, Ryan.
Yeah. Thanks, Casey.